Get away from numbers. Okay, Mr. Duemmler is the COO and Managing Director of Asset Management. He's been with Kenny Anderson, that's the name of the company, since the launch of its real estate platform in 2007 and is responsible for its real estate investment operations and all asset management activities. Mr. Duemmler has also served as Chief Investment Officer until 2012 when Mr. Selznick joined the firm, and he continues to serve as a member of the investment committee. Mr. Duemmler has over 30 years of wide-ranging experience in real estate and financial services. As Executive Vice President of Intrepid Capital Partners, a U.S.-based investment firm, he was a key player in the successful float of a $750 million real estate investment company on the London Stock Exchange. Exchange is AIM. AIM stands for?
Alternative investment.
Alternative investment.
It's a subset. It's like the NASDAQ is here in this country.
Got it.
It is the London Stock.
Okay, and I always think of the FTSE as being New London Stock Exchange, which is like the New York Stock Exchange. And the subsequent investment of those funds in several mixed-use real estate developments in India. Mr. Duemmler has also held senior positions at numerous leading investment firms, including Merrill Lynch, where he successfully built a commercial mortgage origination group, developed innovative real estate financing vehicles, managed and restructured over $700 million in commercial real estate loans, and structured over $400 million in merchant banking transactions. He raised equity capital for numerous real estate developments, and as a private banker at Chase, now J.P. Morgan Chase, and PNC, which, by the way, stands for Pittsburgh National Bank, advised high net worth with clients on real estate investment and finance opportunities, as well as hedging strategies. He started his career at a large Wall Street firm handling real estate and equipment finance transactions, as well as corporate and municipal debt offerings. He earned a JD cum laude from Washington and Lee University of Law and a BA with honors in economics from Colgate University. Let's put our hands together and welcome.
Thank you, everybody.
Here, let me decorate you some.
That's for the camera.
That goes to the camera. This is for
the room here.
Yeah.
I was waiting for the makeup people, but they said they were busy with somebody else. So, any event.
Oh, they were making that up.
Thank you very much. That was a kind introduction. If you're like me, you hear a lot of words about background and stuff like that, and you say, "Oh, so who is this guy? What does he do?" You know, it all sounds fancy, but at the end of the day, it's just a bunch of words on a piece of paper, which of course is all about resume writing and so forth. Make sure that you position yourself properly and so forth. I hark back to a resume was done for me by one company with whom I worked. It was really a public speaking position that I had, and they put together a portfolio on my background, and they mentioned that I was a nationally acclaimed author. Well, in law school, I wrote a paper on copyright protection that happened to get published in the National Copyright Journal, and it won 5th prize in the Nathan Burke competition. Well, I guess that makes me a nationally acclaimed author. But so, you know, it's always interesting how people put spin on things, but I've seen a lot of stuff, and I've been in a lot of places and dealt with a lot of problems. As I said, I've seen the good, the bad, and the ugly. And what I realized, a little like Steve Jobs, and I don't know how many of you have seen the YouTube video of his commencement speech many years ago, where he said, you don't really know why you're there until you look back and you start to see how your career comes together and assembles itself into where you are today. And I'm a big example of that and a big proponent of stepping into life and just experiencing things along the way and letting them guide and direct you into the place that you're eventually going to wind up. I don't think everybody can be Bill Clinton and know they want to run for president when they're 14. So from my perspective, it served me well, and I'm going to talk a little bit about that experience and what we've accomplished at Kane Anderson and then talk to you a little bit about some of the things I've learned along the way in the hopes that they can serve you well as you embark on your next careers with the experience that you're getting here at FAU. I don't exactly know whether we're going to have a presentation or not. It's really more of an outline or a guide to help keep track of the things we're going to cover. How we doing here?
I'm trying to get the remote to work.
Okay. All right. Let me just tell you a little bit about where I was 8 years ago, 2007. I had known my partner for a period of time before that. We had been introduced by a mutual friend. And Kayne Anderson Capital Advisors, which is a firm headquartered in Los Angeles, is an alternative investment firm, and their biggest category of investment for their limited partners was the energy sector. And so if you're out there and you Google and you try to find something about Kayne Anderson, they're probably best known for their foray into the energy world, oil and gas in particular. And they wanted to start a real estate platform. But they didn't want to just do real estate the way everybody else was doing real estate. Kayne Anderson's philosophy is to find niches in the economy as a whole that are much more fragmented, have an absence of sophistication and liquidity to them, and bring a team of experts to bear to uncover the diamonds in the rough, so to speak, and create value for their investors. And so the thing that they were looking at were real estate investments in areas such as student housing, self-storage, medical office, places that are out of the traditional lines of retail, multifamily, office, hospitality. And my partner had been doing student housing for a period of time, and that piqued their interest. So in 2007, he and I joined Kayne Anderson, created their real estate platform, which back then started with an investment of $1.5 million at a small university out in Macomb, Illinois, and has since grown to almost $3 billion in equity that we've raised over the last 8 years and put to work in student housing, self-storage, conventional multifamily, medical office, and also into senior housing. And so it's been a real dramatic growth part. We started with 5 people in a little office up in Westchester County, New York, and have since grown to 45 people here in beautiful Boca Raton, Florida, where we moved 2 years ago. And I'm thrilled to say 22 of the 25 people that were with us in New York came down and stayed with us, which is an incredible joy to have everybody still working together. So that was where we started. A large part of our business was trying to build relationships in the marketplace that would allow us to develop opportunities without having to go to the realtor sheets and look for things that everybody else would see. And one interesting aspect of our business, remember 708, Lehman Brothers. I don't know how many of you were in the financial service industry at that point in time, but the world was falling apart. Chicken was running around the street saying the sky is falling, the sky is falling. And for a period of time it seemed like it was. And we were in the midst of all that raising our first fund, trying to raise $150 million from investors during a period of time where nobody knew what their bank account was going to look like the next day, let alone a month or 2 years from there. Well, we were able to do it thanks to the strength of Kayne Anderson and their relationships. But we went into 2009 thinking there was going to be a flood of opportunity for us as people were really getting stressed and nervous and just selling out at rock bottom prices. Well, that didn't occur. A lot of money was raised to capitalize on the stress in the economy. And it sat there because people this time around were a little smarter than the past, and they said, you know what, I'm not going to sell at rock bottom, unless they had to, of course. But instead of sitting there and not doing much, we spent the entire year going out and building relationships with development partners, with financing sources, with people who are intermediaries that could introduce us to folks that needed capital. And in 2010, our business exploded. All of a sudden, we had more opportunities than we could address at that point in time, and it's been that way ever since, which has caused us to grow but even in the growth we've had, we're still straining at the seams. So it's been a tremendous experience, but one that's been stressful over the last several years. And my wife, if she was sitting in the audience, would shake her head and say, yes, when's he coming home? In any event, you can tell I'm a little lost without the points that I need to go to. So let me talk about the three most important things in a business. First of all, how many people are familiar with private equity real estate? Is there anybody in the room that has experience with that? One? Let me just tell you what it is. I always start off as if everybody knows this stuff. But private equity real estate is what's referred to as an alternative investment class. So aside from stocks and bonds, which all of us can go online through various brokerage firms and we can buy, alternative investment vehicles are generally speaking privately placed, which means that they're not available for you to buy through a stock exchange or something like that. And the SEC also requires that people who invest in those vehicles have a certain level of sophistication and financial wherewithal to be able to suffer the loss in the event that things don't work out the way they were intended to. And that's primarily because there's no liquidity. Once you're in, you're in. You can't really sell it. You have to wait until the fund that you put your money into sells the assets that it bought to realize a return on your investment. So it's called private because it's not available to the general public. It's called equity because we don't lend money. We actually put the equity in and then we borrow the money to complete the purchase. And obviously it's in real estate, but real estate has a broad range, and you'll see many firms all the way from the Blackstones and KKRs of the world that invest tens of billions of dollars in real estate to our world where we're investing anywhere between $30 and $100 million or $200 million in a particular deal or a particular set of deals. So in private equity, we're not manufacturing anything, we're buying stuff. And we're managing it in the hopes that we can manage it better than the last guy, manage it into a strengthening economy, a strong marketplace, command higher rents over time, and sell to somebody else at a much higher price than what we bought it at. So in my mind, there's three important equations to that part of business, but I venture to say of any business. One is people. And I think in a day of technology and science, it's easy to forget that at the end of the day, it all boils down to people. Who the people are, how they interact with each other, what kind of character and values they have, and what kind of fundamental skills they have. And I'm sure many of you come from different backgrounds and have different work experiences. At the end of the day, it's not about the specialty that you have, it's about how you approach that specialty, how you think, how you respond to problems and crisis when it occurs, how you manage and lead other people, how you interact with your colleagues and form partnerships and teams to be able to solve the problems that invariably occur during the course of a business's life. So people, in my mind, is always number one. The second thing is process. I don't care what business you're in, but if you go out there and you involve yourself in chaos, it's really hard to be effective. It's important to have a process in place by which you and the team and the people in your organization get together and do the same thing or follow the same rules and the same methodology time and time again. I'm a general aviation pilot, and one thing that's drilled into you during your training is your checklist. Doesn't matter whether the plane had just come back from somebody flying it or whether you just came down and went to get a hamburger and now you're going back out to the plane. What you're doing is you're taking your checklist and you're walking around the plane, you're checking every aspect of that plane to make sure that it's in flying condition. We don't typically do that with our cars because cars have gotten to the point now where they're fairly efficient, but I can remember a time when you checked the oil in your car before you drove, you checked the air pressure in your tires. Now we have all this electronic gadgets that can tell you what's maybe wrong with the car. But you go through a process, you go through it all the time. My kids joke about me that I put the left turn or right turn signal on when I leave the driveway. Well, it's just force of habit. If you get into a habit and you do the same thing over and over again, you can assure yourself that you're never going to forget to do it when you really need to. So process is an important element of business success. The third one, which is obvious to most people, is product. What's not always obvious is that's not number one, that's number three. You'll hear plenty of stories about organizations that have great product and fail. And you scratch your head and say, how could that happen? Or the flip side is you have great people in process. You find less situations where you have a product that fails when it should, because somehow or another people are able to carve a niche for themselves or differentiate themselves or make something of it. I mean, why do we have an aisle in the supermarket that has cereal boxes going down the whole aisle when there used to be just a handful of choices? Well, because people cleverly have figured out from the psychology of human behavior that if you split rice checks up into 10 different flavors, people buy more rice checks. So if you have a process by which you examine your market and understand the demographics and understand the needs, you can capitalize even a crowded market on introducing another product. That's what I was going to talk about during the course, and there were some slides to go over that. So what I wanted to do is to talk about how each of those pieces fit into our business. People, I talked a little bit about, we have an exhaustive interview process, and we try to get everybody in our organization. I know it can be, if you ever come to our place and you go through an interview process, there are 45 people in the organization. There's a lot of people to interview with. Well, we don't have everybody interview, but we have a good 15 to 20 people at least interview from each part of our business, because we want to understand that the culture is right, that the way you act, the way they act, that it's a marriage of people who feel this is the place they belong and this is the place they want to be. And we do that because we want people to be with us for a long period of time, and they're going to be living with each other during the course of the workday for long periods of time. So having that cultural aspect, and you can't get that from a resume, and you can't get that from just somebody sending a cover note. I will tell you, one guy who joined us early on in life actually came to us by way of an email, an unsolicited email. And I don't usually respond to emails, but there was something about the way he wrote the email that captured my attention. And this is another thing to bear in mind when you're out there in the job hunting mode, and that is that it's a numbers game, right? Everybody responds to things differently. It's still most important if you can find a soft introduction, if you can find somebody that you know who can connect you with somebody else. But if you're going to reach out, try to target where you're going to be. And he was with a developer in upstate New York that did student housing. He noticed that we were involved in student housing. My name was on the website, so he wrote to me specifically. He talked about the student housing development he was working on and what he was interested in pursuing and what he thought he could do within our organization. And it was the way he wrote it as well as the message that he delivered that captured my attention. He started as a vice president within our group, and he's now managing director. He heads up the student and conventional housing sector for us, which deals with all the student and conventional housing we have across the country. So, and he's a young guy. He's in his mid-30s, just had a baby, and has a great future ahead of him. He's vested in the partnership. So in a short span of time, 6 years, he's made quite a mark for himself.
You're on the air.
I'm on the air? Okay, awesome. So if you'll forgive me for a minute, let me just see where...
All you have to do is signal me.
Okay, well, we can move forward here from this quite a ways. Keep going. I talked about that. Just talk about the people process. Keep going. All right, so let's just talk. I've captured some of this along the way, but I want to go over this, the people aspect. So I talked about cultural fit. When you're in an organization, that's the toughest thing to gauge. People are on their best behavior when they're in an interview. Some people are very nervous in an interview. You can't hold that against them because they might be great people when they're not as nervous. Integrity is right at the top. And I tell these groups with whom I speak that integrity is not something you do. It's something you are. It's like turning on that signal all the time. Integrity, it has to be part of you. It can't be something you think about and say, well, is this the right thing to do or not the right thing to do? You really live it every day. And I graduated from law school back in 1976, and we had a professional responsibilities course that was supposed to teach us about ethics. I always found it fascinating because I never understood how you teach ethics, and I'm sure FAU has courses on ethics as well. I think what the objective is to present situations so that you understand how to respond to the situations based on not only your gut, but what the proper professional responsibility codes might be, because the world is pretty complicated. But if you have integrity in you, 9 times out of 10, there won't be a rule about it. It'll be your gut telling you what it is you should do. And an old former chairman of Merrill Lynch, where I worked for a few years, said that we make more money off the deals we don't do than the deals we do. And that's because avoiding problems is about knowing what just doesn't seem right, what doesn't feel right, whether it's a partner that you've been asked to go into partnership with, or whether it's a deal. Let your gut be the guide as to whether this sounds right or doesn't sound right. The numbers can say everything great, but you can find yourself in a lot of trouble with the wrong partner. Entrepreneurial. I know there are programs at FAU teaching entrepreneurship and getting you engaged in that process. We have a very entrepreneurial organization, and by that I mean we encourage people to take on challenge and to think about new opportunities on their own, to act as if it was their business. We want owners, as we say, not employees. And that's an important mindset to have in business in general. If you see issues, if you see something that can be improved, I think it's incumbent upon all of us to step forward and to make some suggestions. And it's not just about finding the issue. I tell my people all the time, I don't want to hear just the problem. I want to hear what your thoughts are on the solution. If you can come in, identify a problem, and come to the table with a proposed solution, you're going to go very far. Because businesses, again, are getting too complicated and people are getting very specialized, and sometimes they lose sight of the picture. And if you see things that others don't, it will help you grow within an organization. Team dynamic, we talked about the culture and so forth. The other one on here is common sense. Old word, term, my mom talks about sometimes my not having enough common sense. But I think it's important to remember that all the book learning in the world, all the studying, is an attempt to make you knowledgeable about certain aspects of business, of finance, of whatever category you're studying. That doesn't mean that you eliminate your thought process and just follow whatever the textbook tells you. Some things just don't make sense. My favorite thing, and it happened recently in the last couple of days, we're dealing with a lender on a piece of property that we own, and we're building 24 more independent living units at the senior housing community in Georgia. And in 40 years of my life, I've never had this happen to me. The lender is wanting a letter of credit. I don't know if you know what a letter of credit is, but it's essentially a guarantee from the bank to, in this case, the other lender, saying that if we don't build this 24 units, that they can go to, in this case, Wells Fargo, and they can collect on that letter of credit, the full amount of the letter of credit, so that they could complete the project. Because they don't want to have a half-built project on their property. I get that. It was getting too complicated, so we offered them cash. We'll just put the cash and we'll put it in an account, and you'll have the cash as security. Sent an email back. We don't want cash, we want a letter of credit. I have no idea where the common sense came from in that equation, but that's what it is. Then, all right, so we'll go through the letter of credit. Now we have to fill out the application. The application requires an identification of what are the conditions under which the person receiving the letter of credit can draw down on it. So we're inquiring. The answer came back, the letter of credit should not be drawn upon. All right, so why do we need a letter of credit? That's the whole purpose of a letter of credit, so you can draw on it when you have a problem. So common sense sometimes escapes the world. Don't let it escape you. Relationship focused, I talked a little bit about that in '09. We have a wonderful story about a partner of ours who, and it goes both ways, who's built 13 projects for us, and we've joint ventured with him on the 13 projects. And there was a project in Baton Rouge, Louisiana, that we had purchased from them, and we had agreed with them to build an additional phase. And that additional phase would have generated about $3 to $4 million in profit for them at the end of the day. Well, just before we started the third phase, we had already agreed to it. We had no documents, there was nothing signed, but we had a handshake and we told them we would do it. Just before we went ahead with the deal, we sold that property to a large public REIT. And the public REIT didn't want to do the additional phase. So we went to our partner and we said, here's the bad news. We're not going to build the third phase. Here's the good news. We're going to pay you $3.6 million anyway. That's a relationship. You foster a bond, you foster a strength. The flip side of that was they built a project for us in North Carolina. The weather was terrible, washed out. It was built on top of a hill. I don't know how many of you know Boone, North Carolina, Appalachian State University. And we built a project literally on the top of a mountain, cut off the top, put the project up there. Well, they had tremendous rains 2 years ago, and the retaining wall collapsed, washed out the whole side of the mountain. No way to get up, no way to get down. Fortunately, nobody was up there when it collapsed. Set the project back by several months. It was a disaster. It's since been built and occupied. It's a great project, looks beautiful, but our partners spent $12 million of their own money to complete the project to make sure that we didn't have to absorb any of it. That's a relationship. Experience, we talked about. Skill, we talked about it. I just want to mention one thing about skill, and that is something I referenced a little bit before, and that is it doesn't matter how much you know, it's how you use what you know that's important. And I would rather take somebody that has many of these other qualities and teach them real estate than to take somebody who knows everything there is about real estate and doesn't have any of the other qualities. That's why people come first. You find the right person, you can teach them just about anything. You can't. Don't be so focused on knowledge that you lose sight of the other attributes and the skills and the application of those tools and knowledge in the real world. That's what really separates people from each other. Next. Process. We talked a little bit about teamwork and collaboration. I think that's just so important. And in a day and age when it's easy to separate ourselves, one mantra in my office that I keep harping on is emails. Emails drive me absolutely crazy because pick up a phone and make a phone call, particularly if it's bad news or it's a challenge or something else that requires some dialogue. Don't use the emails to communicate back and forth for two reasons. One, you can't convey everything in an email. And number two, when you're writing the email, you're not thinking about how the other person is reading the email. And I can't tell you how many times an innocent email goes out and the person on the other end takes it as offensive. I don't mean, sexually or something like that, but from a business perspective, is offended by it, is angered by it, reacts to it, and whips another email back. Well, it doesn't take too many emails before something that was not an issue escalates to an issue. And that's something that's very important to keep in mind. You need to collaborate. We're still human beings. We're still people. We still need to interact with each other, understand each other's perspective. Listening before talking is important. Trying to understand a person's perspective, that all goes back to relationship. Clear understanding. Everybody needs to know what has to be done, how it has to be done, what the time frames are within which it has to be done. If not everybody is on the same ship, pulling the oars at the same time, heading in the same direction, process collapses. So making sure everybody's on board, that they all have an understanding of what's needed, is an important part of the equation. And I know there's, at least when I was in business school, there's a lot of collaborative effort on projects or team efforts and so forth. I don't know how it is with this program, but you know, it can be difficult at times, right? You sit there and you say to yourself, shoot, you know, we have different work schedules, we live in different parts of the community. How do we get together to work? Well, even if you're on the phone, even if you're doing it online through Facebook or however those things work, the interaction and collaboration and being able to form something from the group effort is very important. Discipline in the face of pressure. Think about this. If you're the President of the United States, John Kennedy probably predates a lot of you folks, but the Cuban Missile Crisis, and you're faced with decisions, and if you make the wrong decision, the risk is war, the risk is patient dying on the operating table. Fortunately, in my business, I don't have those kinds of risks, but you will constantly face pressure in life to do things quickly, to do things that maybe your gut's telling you we shouldn't be doing. And it's how you handle yourself under those circumstances and address those issues and move the discussion or move the process to a point of positiveness that will differentiate you from others in the world. So you can't buckle when crisis occurs. In fact, you have to rise above it, and that's precisely the point where you have to be calm, cool, collected, as they say. Reward and celebration. This is very important. We're human beings. Criticism or critical feedback is an important part of learning. But praise is also a part of learning. The dogs, things, well, we're animals at the end of the day, and we respond to positive and negative. If it's all negative, it doesn't work. If it's all positive, it doesn't work. So find opportunities, and it doesn't have to be compensation. If you're in a management role, take your team out. I took my finance group out bowling, and we're doing that now on a quarterly basis. You'd be amazed at how much that restores the spirit, the vitality, the energy that the people in the group have. It's not always about money, which I think is part of the excellence. Winning isn't everything. One of the things you have to figure out for yourself in life is, how do you measure success? What does success mean to you? And it'll be different for everybody. Success can be a matter of having accomplished something that just you've been wanting to do all your life. My wife went back to get her master's at 52 years of age, and she got her master's in clinical counseling. That was something she wanted to do. She hasn't applied it yet, but it was an accomplishment, and it was something that, in her mind, made her a winner. You have to figure that out as well for yourself. And winning isn't, in a negotiation or a relationship, isn't about what you get and they lose. You've heard the expressions win-win. It's got to be win-win. You don't want people to walk away from a situation feeling like they had to give up something in order for you to get something. The trick is to figure out how both sides can win. And money isn't everything as well. So I think you have to define your own success and figure out how and what works for you best. Go ahead, how we doing? In the context of process, I just wanted to show you a little bit about what we go through in our business. We obviously get opportunities from a wide variety of sources, which is in the top left on the sourcing side. And that all filters through our team, which really looks at the opportunities, tries to understand it not only from a financial perspective, but from a locational perspective, demographic perspective, so that we can come up with a list of the ones that are actually worth pursuing. And then we go into a more detailed analysis with those, and we do a significant amount of due diligence. Our team, by the way, is not comprised of just financial people. We have a design and construction management group. We have an in-house legal group. We have an in-house finance and accounting group. We have even a business strategies group in-house, because our business has been a lot around student housing, and they are focused on tapping into national programs. We have a worldwide, Universal Records has a subsidiary called Interscope. We have this relationship with them that is bringing emerging artists to the campus communities in which we have assets and hosting meet and greets at our properties. We have a relationship with Zipcar now at our properties, with Zagster, which is bike sharing. Their whole mantra and game plan is to figure out how do we differentiate ourselves from our competition. It's turned into an amenities race. Who has the bigger pool? Who has more saunas? When I was going to school, it was cinder block construction. It met the Miami-Dade County hurricane rules, and that was it. Now it's all about what are all the other amenities? What are the fancies that everybody gets? Granite countertops, stainless steel appliances. I mean, my gosh. It's going to take years after college for the students who are there today to find a home and an accommodation like they have in school. So you have to, at the end of the day, say to yourself, where is this going? It's like, okay, we keep building up nuclear arms. Where does it go? Where does it stop? And I think what's happened is you're seeing a reaction in the world to the material side and saying, you know what, we want something that feels like a community. I make it the analogy to Greek life. They want to know when they live somewhere that there's something special about the place that keeps them there and that they can tell their friends about and their friends will want to come to. So that's what this business strategies group is trying to accomplish. So anyway, when we get through this with the negotiations and the due diligence, we have an investment committee. You want to have somebody who's asking you the right questions, who's checking and challenging you on the information that you provided to make sure the deal is worthwhile before you actually go and close the deal. So if you look at the numbers, we start with 100 and we have 2 at the end. You're looking at a lot of deals to do the ones that fill $3 billion worth of equity. That's part of that pressure. And it's something in the private equity world that I don't think anybody has fully been able to resolve, and that is we make fees off of the money we raise. Right? So we just closed a fund that had $1 billion in commitments for it. And our fee on average is about 1.65%. Now you can do the math and see how much revenue, you get that revenue every year from the very beginning. In the beginning, you don't have any investments. There's no cash to support that fee. So that money comes from our investors. They pay us until we have enough investments so that the cash flow from those will pay for the fee. So in the private equity world, when you start to see things like KKR and Blackstone raising a $20 billion fund, and even if you're taking 1% because you get to that size and the fees change dramatically, you're talking about $200 million in fees every year, which is why a lot of these firms have gone public. And because they're trying to not just have the fee, they want to actually capitalize on the value that those fees have from an income perspective. So $200 million in annual recurring revenue is worth a heck of a lot more than $200 million. So that's the dilemma, right? You earn more fees by raising more capital, but if you raise more capital, are there enough deals to put the money to work? And our investors ask us that all the time. Are you raising $1 billion because you want to get the fees, or are you raising $1 billion because you actually have opportunities to invest in them? And in most instances, we have 40 to 50% of the fund already earmarked for investments before we close on the fund, because we've been very cautious about making sure we don't overreach in the situation and create that issue. Can I tell you the pressure doesn't exist? No, the pressure always exists. To raise the capital, put it to work quickly so you can go on to raise the next fund. Anyway, that gives you a little idea of the process by which we go to and the sort of statistical perspective on how much you actually do based on what you see. Let's go to the next. All right, so product. I talked a little bit about that with our business strategies group, right? Differentiation. What makes Bounty paper towels different from Scott's? I don't know personally, but I'm just throwing out the question. What makes one soup different from another soup? In the consumer markets, there's always a challenge to creating differentiation. My favorite is new and improved. New and improved means they charge the same price, they give you a couple ounces less of the material, and they stick new and improve on it. I don't know, the detergent worked fine before. I don't need a new and improved for the detergent work now. But be that as it may, how are you going to separate yourself from the pack? And it's not by different advertising and marketing and so forth. I mean, buses are wrapped in advertisements. The airports have advertisements all over, billboards. We're saturated with advertising all the time. I really think it boils down to two things. One, relationship, and the other one is experience. Relationships are solid and people don't trade at the margin. If you have a bank relationship and there's a person at the bank that always solves your problem, always helps you, the customer service line is very friendly, you never have an issue with your checking account or your bank account or your credit card and so forth, how likely is it you're going to buy into somebody else who says, sign up today and we'll give you a $50 gift card? Really? You're not going to switch. The relationship's too good. You don't know what you're going to get. So relationships are very important. But the other thing is the experience. And I think people are clamoring more and more for that. What is the experience I get in a restaurant, in a retail center? It's just the salespeople. I go to Best Buy because they're not paid on commission. So you can talk to somebody and not feel like you're getting sold. What is the experience that you're going to have? And what experience are you creating for your clients, your customers, your investors? How are you doing that? That's what's going to separate you from everybody else. Simple to describe. Has anybody been in a talk or a lecture, present company excluded perhaps, that you sat there and you had no idea what the person was talking about? You know by their credentials they had doctorates and they were, got the Nobel Peace Prize, everything, but you have no idea what they're talking about. Well, what good is it if you can't communicate the message? That's why you have the kind of teachers you do have in this program who have the real world experience but know how to translate that into something for you. So think about that when you're communicating with people on the outside, with colleagues, with people at the top, people below you. You've got to translate it into something that people understand. What's the problem? Why is it important? How are we addressing it? What's the likely outcome? Boil it down so that people can grasp the essential components of it and save the complicated stuff for the people who are the complicated sort. Limited accessibility. This is an interesting thing. Have you ever had an experience where you're trying to make a reservation at a restaurant and you have to, and I'm from New York, and you have to book months in advance? Anybody ever had that problem? Okay, why do you want to make a reservation at that restaurant?
It was Disney, so you want to make it a memorable experience when you get there.
Right, because people told you it's great or whatever. Well, quite frankly, you can create the same thing in your own business. The key is to make things limited in their accessibility. Because if not everybody can get it, then everybody wants it. It's amazing to me how this works. It's psychology. And when I was doing that public speaking, the same one that put the profile up about nationally acclaimed author, we had it was something called a takeaway, is what they called it in sales. And the idea is to do a couple of things. One, create a deficit. Overwhelm people with how complicated, and I know I talked about simple, you don't have to, the message doesn't have to be complicated, but here's what you need to do to sell your business, which is what I was talking about. And you go through 2 days of all the things you need to do. Financial planning could be another one, whatever it is. And you sit there and you say, oh my gosh, there's no way that I could possibly do this. Good. Because if you're not going to do it, you need somebody who is going to do it for you, which is where I came into play at that point, right? So you then tell them all the ways in which you can solve their problems. Then the takeaway, greatest gift of sales. But I don't do that for everybody. Wow, holy mackerel. You mean you choose who you work with, not I choose who I work with? Amazing. Everybody wants to be part of it. Well, of course, we worked with whoever had the money to pay for the fee. But you reserve that opportunity. And I may be speaking out of school here, but I'm telling you the real world, all right? It's not that you want to do it in such a way that you're misleading people about it. It's just make yourself limited in accessibility. You should have standards and judgments by what clients you'll take on, what partners you'll work with. That's fine. And the more you preserve that, the more other people will want to be part of it. But you want to reserve for your own perspective some decisions on who you're going to choose to do business with. Value creation. At the end of the day, no one's going to pay you to just babysit. How are you going to turn value into me? It's one of the reasons our founder, Rick Kane, has decided that the public markets are not the place to be. Because what makes us think that we're better at managing stocks than bonds than the other 6,000 money managers are out there? The markets are too efficient. There's too much information available. There's really no way to differentiate yourself and create value for your investors. So the private equity world is where we find our niche. And that's where we can work the deal, we can manage it, we can improve it, we can do things to it that will increase its value over time, regardless of what the market does. Whether interest rates go up or down, at the end of the day, we're constantly improving value. We're creating something in the real estate that we buy or develop that has more worth in the future than it does today. That's what people will pay for. Measurable outcomes. This is another important thing. You're going to have a lot of situations in work and business where you want to initiate something. You want to put in place a new product or a new process. Well, you've got to have an understanding of what you expect the outcome to be. From making that investment, from putting another product out in the marketplace, whatever it is, understand what the outcome is. It's one of the, if I can put my one little soapbox, one of the problems with Washington, D.C. is that they don't have a target. They don't have a time frame or an objective by which to say, hey, did we achieve our objective? Did we achieve it? Well, you know, was it successful or was it a failure? No, it's just, if it doesn't work out, they just keep saying it needs more time, so they keep pushing it off further and further and investing more and more dollars in it. But you can't afford to do that in business because you don't have a bottomless pit of wealth to keep funding things that don't work out. So you have to have a point in time in which you're going to say to yourself, I'm going to measure it. I'm going to see whether it exceeded or fell short of our goals. And if it fell short of our goals, why did it fall short? And if it's a reason on implementation or something else that we can adjust, that's one thing. But if more likely than not, it just didn't work, it's time to cut it short and move on to something else. So you have to have a measurable outcome. You have to know what success is and failure. Next. I talked a lot about these things. Just wanted to give you an overview of private equity. In the private equity, remember the $1 billion I talked about, and you pay a fee. One other important distinction between what we do and what mutual funds and other things do is we don't actually collect checks for $1 billion and put them in a bank account someplace. That would be a disaster because the bank accounts are paying 10 basis points and our investors are expecting 15% return on their money, net of all the fees and things that we wind up paying ourselves. So we have what's called commitments, and investors commit a certain amount of money to the fund. And in our case, it ranges anywhere from $500,000 to $200 million. And what that means is that when we have a need for capital, we send them a notice and they have to deliver the money to us. If they don't deliver the money to us, there are severe penalties such as forfeiture of your interest, loss of the economic reward that you've had for the period of time. So nobody wants to default, and I'm happy to say that in the 25 years that Kane Anderson has been doing this, we've never had an investor default. It was one of the issues back in 2008 because we had soft commitments of about $200 million and we were concerned about having too many for our first fund, but a lot of people backed out because they just didn't feel comfortable making a commitment without knowing what the landscape was going to look like down the road. So they're all done by virtue of commitment. Sequential closing is not important. Fees, we talked a little bit about that. That whole experience, by the way, where you're paying fees up front, but there's no investments to generate cash flow, That period of time until there's cash flow from reinvestments to cover the fee is called the J curve. It sinks, right? The returns actually go negative initially with respect to the fund because we have all expenses and no income. And then they start to escalate as you generate investments that are bringing cash flow in. Distributions in the waterfall, all right? I'm sure you've heard all the politicians speak about carried interest. Everybody heard about carried interest? The big bad carried interest in the private equity world? Well, what this is when the investors make a profit, we make a profit. So we get a cut of the profits that our investors make at the end of the day. But they have to get their capital back first. They have to get a minimum return, in our case 8% back first. And then what occurs after that, we get to split with them. In our case, we keep 20%, they keep 80%. That's called the carried interest. And just so all of you know, for purposes of the political landscape, the debate is over whether the carried interest should be treated the way it is now, which is a capital gain. The philosophy behind that being that, you're working years and years and years, you have sweat equity that you're contributing to generate that value at the end of the day. Or is it ordinary income, where you're just getting it in the year in which you get it, but there's really no period of time or no capital base that you've been investing in to get that. It's just like a salary. That's what the debate is, and whatever side you're on, that's just to clarify, it's all about how to treat carried interest for tax purposes. Doing business right, doing the right business. I'm sure you've heard that expression before. We've gone through some of these things here. Relationships, strong alignment of interests, make sure you and your partner are working for the same cause. The only thing that I wanted to really focus on is the second to last one, about focused on making money in absolute terms. One mantra we have at Kayne Anderson is return of capital before return on capital. At the end of the day, what you want to do is you want to look at the totality of the return to the investment, to the investor, both a return of their capital as well as a return on the capital. So preservation of the dollars themselves is very important. And a lot of people take lots of risk because they see the return, the relative return, right? The one that says, oh, I can get 10% on my money as opposed to a bank account which has 10 basis points on it. When you see that, it looks pretty attractive. But understanding what the risk is associated with that is an important consideration. The market's efficient enough to know that safety is priced low, risk is priced high. And you have to understand what that equation is and know how to manage that risk. You go to the next slide. So these are sort of summary of some of the things we've talked about. The golden rule, I talked about that. It's kind of listening. Put yourself in the other person's shoes, whether it's emails, whether it's conversation, whether it's business decisions that you make in life. How is it going to impact the people on the other side? Put yourself in their shoes and understand what impact it's going to have on others. Too often we get caught up in what impact things have on us without focusing on the impact on others. Integrity, we talked about that, something you live, you are. It's not something you do. Learn something new every day. I don't know how many of you go through the day and observe lots of things. I observe everything. Whether it's a color on a house, whether it's a display in a retail establishment, you notice things and then you ask questions about it. You see a display of a product that you never saw before, you go up, you read it, maybe you jot down the website and you go online. Learning is part of life, and what you learn here at FAU is critical, but don't think of learning just in terms of your own position or your own career. Learning is broad. You can learn something new every day about things that have absolutely no impact on your business, but it stimulates the mind and it rounds out your individuality. And you'd be surprised how many times you meet people or you're in conversation with people and you just talk about things, and all of a sudden some of that that clutter in the back comes to the forefront and say, oh yeah, I remember, I saw this the other day, or I read about that product. Or it's great when people can have a dialogue beyond something that's just related to their specific career. Put your faith in people, not in things. I can say that I'm 62. When I was 25, I don't know if I followed that philosophy, but at the end of the day, things will let you down all the time. The computer today, right? Well, we took 20 minutes to try to figure out how to get that to work. People will let you down, so it's important to be with the right people. If you're with the right people, going back to people first, they will never let you down. They'll always be there for you. You'll always be there for them. It's all about relationships. So put people first. Never send an email in anger or frustration. I talked about that already, right? You're not whipping it off thinking what the other person's going to read it. You're thinking what you want to say. And guess what? It's not coming out the way you want to say it. If you have something to say, don't use the medium of email. Pick up a phone and express your frustration, express your anger in a calm tone, and work it out. Call for everything important is the corollary for that. Nobody likes to get an email telling them they're fired. I don't know about you, I wouldn't, right? Pick up a phone. It might be difficult to tell somebody bad news. You know what, partner of ours, we blew the budget by $2 million. You're going to have to cough up some more money. Don't send me that in an email. Pick up the phone. Call us, right? We'll work it out. We'll figure out how to deal with it. Acknowledge mistakes, right? This is not a race to who makes the least amount of mistakes. We all learn from our mistakes. That's the important part of mistakes. If you never make mistakes, you never learn. So in order to improve, to get better at the things you do, we all have to make mistakes. And that's something we encourage in our environment. You'll find in entrepreneurial environments, it's a lot about exploration, experimentation, discovery, because we don't know what's going to work until we try it. In institutions, it's very rigid. It's very much about, oh, don't take any chances, might make a mistake. Well, that's the way we get better at what we do. And lastly, take ownership. We talked a little bit about that, right? We want owners, not employees. It doesn't matter what your position is in the company. You could be working in the mailroom. You could be, shuffling papers in somebody's desk. It doesn't matter. Take ownership of what you're doing, ownership of your part in the organization, and do it the best you can possibly do it. And do it with joy, with positiveness, and always be thinking about how you can improve your job, how you can improve somebody else's job, their things about the business, because that's what shines through. So that kind of my summary. I think I have one more slide that one of my favorite commercials. You can tell by the Ferrari that's very old. But this was in the Wall Street Journal. Actually, it couldn't have been in the Wall Street Journal because the Wall Street Journal didn't have color back then. But anyway, as you can see from the top, it says what can be conceived can be created. And I very much believe that. I think we live in a day and age, we live with a society that rewards ideas, energy, motivation, ambition. If there's something that you want to accomplish in life, don't think of all the things that cause you to not be able to accomplish it. Figure out the things that will allow you to accomplish it. And that goes back to that whole idea of, just start somewhere. Don't worry about being at the end game until you get to the first step. In my career, if you looked at my resume, it's all over the map. I've done so many different things in different places that if you were interviewing me, you'd say, I don't know who this guy is. Well, I'm a problem solver. I'm a person, I think of myself as a puzzle maker. Anybody do those 1,000 or 2,000 piece puzzles, right? And everybody approaches them differently, but you take the puzzles out, you see what the picture is, you know what you want to accomplish. How you put the pieces together to get there is what I'm all about. And I think there's a real need for people like that in our world. So think about taking those skills, those tools, the knowledge that you're getting from a place like FIU, and apply it in life to solve problems, to create the pictures of the future that everybody really wants. That's all I had. I'm more than happy. Thank you very much. I'm more than happy to answer any questions or talk about any subject whatsoever. As long as I know something about it, I'd be happy to share it. Come on. What?
Do we need student housing around FAU?
We almost did the deal. I keep forgetting the name of the new one that was built off of 20th.
Newport?
Was it?
Newport?
New Park? Is that the one there's retail in the front and so forth? I don't know. There's a new one that just went up last year, I think. Yeah, and we almost did that one, but the partner who was involved in that deal then sold out of the deal, and that was our connection. So we didn't do that one. But we have been looking at FAU. We've actually, FAU, Lynn University, we've spoken with both universities about student housing development. And it's something that I gather is needed down in this community. So who knows? We may be involved in the future. Yes, sir.
How you see the construction market in U.S. today and the future?
The construction markets? That's a good question because, as you probably read, there's a lot of construction activity going on. Construction, by and large, is a very regional thing, just like real estate in general. When you look at a national scope, and we're not by no means out of the recession, I think, but there's enough activity going on in different pockets where there's growth. So South Florida is a good example. There's a lot of construction going on. I think that construction activity will continue to grow for the next 4 to 5 years because construction is sort of a laggard. So economy picks up, things go. Construction takes so much time to implement between getting the land, the zoning, the permits, the approvals, the whole bit, that a project that starts today is already got the momentum to get built 3 years from now. So if the economy changes over the next couple of years, it's still going to get built. It'll be the wrong timing for it, but it will get built. So I think 3 or 4 years is good in the construction. I also think it depends on the sector. I don't think you're going to see a lot of development in the retail side nationwide. You'll see pockets of that. I don't think you're going to see a lot of development in the office side unless you're talking about pockets again, because people are using less office space. There's more telecommuting and things like that. The retailers, the big box retailers have gone out of business. There's too much clutter in the retail space. Even malls are having challenges. So I think where you're going to see it is in housing. I think you're going to see it in the medical community, healthcare, hospitals, urgent care centers. I mean, shoot, I've seen 3 of them since I've been here in the last 2 years on Federal Highway, just within a mile or 2 of my house. You'll see it in senior housing. That's an area where we've done a lot of development activity because the aging boomers, the people in the office, I'm the oldest guy, the people in the office joke about the fact that I got my apartment already lined up at one of our communities. That's going to be a driver. And I think that there's some student housing has been on a tear for the last 5 years in terms of development. I don't know if that's going to be sustainable over the next 5 years. I think that's going to plateau off. And I also think that if you're getting into things like hospitality, I don't know enough about that sector, quite frankly, to know how that's going to all shake out. And I think the global perspective is such that one of the reasons why we have such strength in the US is because by comparison, we still look pretty darn good. I mean, we're not in the best shape by any means, but when you compare us to Europe and to what's going on in Asia right now and South America and so forth, you know, if I'm sitting on the world stage trying to figure out where to put my money, I'm going to put it in the US.
Does your company have project management department inside? How do you see how important is project management in your
purchase managing? We don't have something in-house, and the reason for that is because we don't manage our properties on a day-to-day basis.
The construction.
In the construction side, we always work with a development partner, so we never do our own construction. I shouldn't say never. We did it in one instance. But we always work with a development partner, and they have the relationships through which they purchase the material. That said, we have looked more and more at how we can centralize that and gain scale and purchasing power on behalf of all of our partners, because we work with probably 5 or 6 development partners around the country, just in student housing, not to talk about senior housing and other sectors. And we've talked about that from time to time, but the world of construction is an interesting one. You know, it's all about who has what relationships again, and if you try to cut somebody out of the loop, they're going to lose their profitability on the sale. Anyway, and one of our investors actually owns a company that manufactures products that we use in our construction. But we have looked at it. We just haven't gotten to the point yet where we figured out how we can make it work. Yes, sir.
Would you consider Donald Trump more or less a real estate investment capitalist?
I don't know Donald, and I haven't followed his career all that closely. I did read somewhere that if he took his father's wealth and put it into treasuries over the years, he would be in the same position he is now. I don't know if that's true or not, but it might be a statement about his prowess on the real estate front. I don't know anything about Donald and what he's achieved. I did read his book, whatever it is, the Deal, The Art of the Deal, and you know, it was quintessential Donald from my perspective. But yes, sir.
So as I understand, you buy property, you, I guess, develop it or
Right.
rebuild it,
Right.
in some ways modernize it, and then
Right.
you run it for a while and then you sell it.
Correct.
Where is the most value added? Is it at the buying stage or the development stage or the managing stage?
Well, it says we have a saying: if you don't buy right, you'll never sell right. It's a lot about making the right decision up front, because if you make a bad decision, it's almost impossible to recover from it. On the other hand, you can't just buy and hold. I mean, you could, but your returns would be small. And they have funds like that. They're called core funds, where they're essentially buying a very, in real estate parlance, very stable, secure cash flow. But they're only getting returns somewhere between 6 and 8%. Our investors are expecting returns of 15% or more. So in order to accomplish that, we have to find the properties that are undervalued by the market and put something into it, whether it's management, which we do focus a lot on, efficiencies in operations, better marketing strategies to create more demand and increase occupancy or rents. We do look at properties that are older and refurbishing them, new granite countertops, new appliances, new carpeting, you know, fixing up things that shouldn't be, because appearances are everything when people live in homes, and that generates more rent. Developing is a classic time of value add, because now very few people want to take the risk of investing, and then not have somebody occupy. And in student housing in particular, which is very interesting, when you build a conventional building or a medical office building or something like that, okay, so I'm 2 months delayed, all right? So the tenant just moves in when the property is ready. Guess what? Student housing, there isn't a 2-month thing. The kids are starting today. Is your property open or isn't it open? Because if it's not open, we got a problem. So student housing doesn't have as many developers in it because of the risks associated with it. But to your point, each part of it is important depending upon what the development, we're not refurbishing anything, we're building it from scratch. We want to obviously put in the right management, but we're not changing prior management. So it's all about the build and the delivery and the pre-leasing that goes on to make sure when it's completed, it's occupied.
So it's not just flipping.
No. If we're just flipping, everybody would be able to do it.
Right.
Yeah, no.
I was trying to get to the very core of what skills are
Yeah.
needed
Yes.
to add the value that you add.
Yeah, and
I
so
guess you have
while...
to smell the market in some way to buy the right property, and then you have to have the
Yeah,
confidence in
and
place to...
again, it's not about just numbers, right? You could put numbers on a page, and we got into a crisis several years ago because people would just make the model work for whatever it is they wanted to do, right? I want to buy this property. Okay, but the returns are 10%. Let's just increase the rents a little bit, lower the expenses. Guess what? The return's 20%. Oh my gosh, I'm a genius. I figured out how to squeeze 10% more out of a deal. Well, that's not what it's about. And so you do have to invest a lot of time and energy. And the whole thing about carried interest the investors like that because they're saying to themselves, okay, I want you to put in all the time and effort and the sweat and so forth. And guess what? If it doesn't work out, you're not going to get your money. And if it does work out, yeah, you should get some money, but you should get it after I get my minimum out.
What's your incentive structure? How are the deals structured? Do you have a particular time period when you're raising the funds? Let's say, I don't know, 10 years, and you promise that you're going to return the capital along with the returns in 10 years? And if that is the case, do you sell at the end of those 10 years? And so does your business run in cycles, I guess? You run one investment cycle, and then 10 years later, or however many years later, you raise a new fund, and then do it again in that 10 years? Is that how it works?
Well, let me start with the last one. We're always, well, I shouldn't say we're always raising funds, but we don't raise funds in cycles. We essentially raise funds when we get close to the point that we've invested the funds from the previous fund.
Okay.
All right. So we have to be 75% committed on the funds for one fund before we can start raising the next fund. For obvious reasons, your investors don't want you sitting there, oh, I'll give this one to this fund and I'll give this one to that fund. No games here. We want you to finish just about what you started here before you start another one. And we've been on about an 18 to 22 month investment cycle before we raise the next fund. And the way it works is when you raise a fund like the one we closed in April of this year, we have 3 years under the terms of the fund vehicle to put the money to work. And then we have another 5 years to reap the rewards of the fund. Because that just is too much of a defined date, we also have the opportunity as general partners of these funds or managers of these funds to extend that 5 years for another 2 years. The market may not be right, the property may not be in the best shape with which to sell, but during the course of those 7 years, ultimately, we're always selling. Always. I mean, we're selling as opportunities present themselves. So the hope is that by the time we get to the 5th or 6th or 7th year, we're really pretty much wound down, as they refer to it, of the fund, and there's only a couple of things left to sell. So, you know,
What do you do with the money, though? If you sell, then you reinvest it? Or?
Well, there are two things that can happen with the money that you get. One, you distribute it back to the investors, right? Which is what we're supposed to do anyway. But there are provisions in a fund, usually within the early part of a fund's life, where if you sell something, you can take those funds and reinvest it in the same fund in another opportunity. And what ideally happens is that over the course of those 5 years when we're realizing on our investments, we're raising other funds. So now it's great, right? Here, investors, your check for a few $1 million. Oh, by the way, I have a fund over here. Wouldn't you like to invest? So it sort of just keeps the money flowing around, right? It's like Wall Street with trading. The person sells it, this person who sells it, that person. Guess what? They're making a fee each time they sell it, all right? It's still the same stock or the same dollar just floating around. But typically, that's what happens. Yes, ma'am.
How does a small equity firm grow when it doesn't have, like, it's not public and there's not like a lot of information out there? Is it on integrity, like audited finances? How does it grow, like a key to it growing, like a small equity firm?
You talking about an equity firm that's looking to make investments in things, or?
Like for people to invest in it and all of that.
You're talking about how does somebody invest in a firm that's not public, that doesn't?
Yeah, like how do you, like, getting credibility and all that when the accounts are not public?
Understood. Well, one thing that was up there, first-time funds, if you're going to institutional investors, now these are pension plans, these are life companies, the folks that operate with other people's money as part of them, they don't like to invest in first-time funds. If this is the first time you've done a fund, it doesn't matter how much experience the people who are running the fund have, they don't like to be in the first one. So you have to do a second or third or fourth before you can attract that kind of money. Number two, a lot of our investors have had relationships with Kane Anderson over 25 years. And their relationship with Kane Anderson has led them to believe that if Kane Anderson puts its mind to doing something, it's going to be a pretty good investment. So they're first and foremost investing in a firm and its experience, integrity that's been around for a long period of time. Then the third thing is, who's the team? Who are the players that are actually going to put this money to work for me? What's their experience? Meeting them, talking to them, understanding what their philosophy is, their approach, understanding what process they use by which they make investment decisions. These are all the factors that someone who's looking to put money to work has to go through to feel comfortable that this is a good place to put your money. In the public arena, it's almost a disadvantage because everything is about statistical numbers, right? And analysts are measuring companies quarter to quarter, so forth. Nobody's really taking time anymore to understand the management team, their philosophy, how they approach things. They're just looking at numbers. In our business, you have to very much focus on the people, the process, the investment philosophy, and so forth, because when you start a fund, you don't have any numbers. Now, we do have track record that we have on prior funds that we're now using with future funds, and there are SEC rules and what you can say and what you can't say. Your favorite expression, past performance is not indicative of future results, right? Look at the fine print on any investment opportunity. Past performance is not indicative of future results. So we can put it out there, but we can't promise that it'll be like it was before. But that's all right. Everybody is investing because they're expecting the same kind of return in the future. So that's what it is.
On that note, I would like to thank
Oh my
you
gosh,
for
you always
being
do
with
this.
us again, Frank.
You've been wonderful.